Hi everyone, I'll just give people a few more seconds to join us. Okay, we'll get started. Thank you all so much for joining us today. Hope you're looking forward to today's webinar. We're delighted to have Ryan and Grant here from Integro Accounting to take us through the next hour's lunchtime webinar. Just a few things from me. We have a chat box down the bottom. Please feel free to chat amongst yourself within that. There is also a Q&A box at the bottom that if you wish to ask Ryan and Grant any questions, you can do so in there. And if there's time, they will try and answer them towards the end of the webinar. I hope you all enjoy it, and I'll pass over to you now, Grant. Thank you.
Thanks, Lisa. So hi, everyone. My name's Grant, and I am one of the senior accountants here at Integro, and I deal with and handle a lot of our new client signups and inquiries. Today with Ryan, as Lisa said, we're going to be hosting today's session, looking at all things kind of limited company versus sole trader. We're going to be looking at obviously the tax side of things, which is quite important, but some of the more, the other details that sometimes are often overlooked, other things that we'll go into, the day-to-day kind of stuff that's in there as well. So if we could go into the next slide, please. We'll tell you a little bit about ourselves. We are Integro Accounting, and we are contractor, freelancer, consultant, specialist firm of accountants. And we have recently won a Self-Employed Supplier Award at the IPSE Freelancer Awards, and also won our category at the Best Contractor Accountancy Under 1,000 Clients at the Contracting Awards 2023. We are founded upon giving the best service possible to our clients. That is the core of our business. We'll give you the best advice we can. We don't work from call centers, and we do still have a service level guarantee, which is obviously quite a big thing. We are based out of Leighton Buzzard, our head office. We have offices in Cheltenham and London as well. And we have clients from all over the UK that are, happy to deal with us online, and we're happy to work with that as well. So now to find out a little bit about you, we're going to pop up a quick poll just to find out if you're working through a limited company or as a sole trader, or maybe you're a partnership or other. So if you could all answer on there for us, that'd be brilliant. So looking like a lot of limited companies, which is good. We do have a few sole traders, and a few others have put themselves as other. So maybe you're a partnership or unsure. In any case, what we're about to show you and go through does apply to everyone. There are going to be people in each camp that maybe are better off somewhere else, and that's exactly why we're going to go through that in the way we will today. I'll be back towards the end. I'm going to pass over to Ryan now. He'll go through, like you said, the differences and the key points, and I'll be back later on to go through questions and answers, and also to go through an offer that we've got for you all here today.
Brilliant. Thanks, Grant, and thanks to IPSE for having us. We're very proud to be part of the freelancing community. I know everyone is on their lunch breaks, so we'll be quick with what we go through now. I'll try not to waffle too much, and at the end Grant will go through some questions and answers that have been submitted. Just very, very quickly, a little bit about myself. I've been with Integro for 7 years. I've been working in the accountancy industry for about 17 or 18 years, mainly working with contractors, freelancers and consultants. So that's a little bit about myself. So first of all, we're going to look at some of the recent changes that has come out this year from the government. Hopefully there shouldn't be any shocks or surprises with what we're seeing here, but One of the biggest ones, more so for limited companies, was the increase in the corporation tax rates that went from 19 to 25%. So it was quite a big jump. But it's not all doom and gloom, because any businesses with profits of under 50,000, you remain at a 19% tax rate. And if you're fortunate enough to have profits over 250,000, sadly, you'll be at the 25% corporation tax rate. But there is a kind of hybrid step rate on profits that are in the middle between 50 to 250. So it's not just a complete jump of 19 to 25%. One of the other biggest changes that came out at the beginning of the tax year was the increase annual allowance from what an individual can contribute or receive into a pension. So that went from 40,000 per year to 60,000. So we're going to have a little look at that a bit later to see how that can impact you and the taxes that you're paying. So first of all, I'm going to go through the day-to-day differences of mainly focusing on sole traders and limited companies. So it's good most of you fit into them two categories. So we look at how quickly you can get set up, the filing requirements for each option, the risks and the responsibilities for you as a business owner with either option. So first of all, how quickly can you get set up? With a sole trader, it is a lot more informal. Effectively, you can start trading straight away. There is a requirement to tell HMRC that you are starting your own business as a sole trader, as self-employed is what they call it. But you don't need to tell HMRC right away. You do need to tell them in the October following the tax year that you start. So for example, if you start trading today, the tax year finishes on the 5th of April 2024. So you need to tell HMRC by October 2024 at latest. Obviously, the sooner the better, but that's the guideline there. Operating as a sole trader, you do not need to have a dedicated bank account, because all the income goes to yourself and it all gets declared on a tax return, which we'll talk about in a bit as well. So it's very quick and easy. Limited company is a lot more informal, a lot more formal, because a company is its own separate tax entity to maybe yourself. So a company is formed through Companies House. It can take up to 3 days for a company to be formed, but sometimes they can be as quick as a couple of hours. Once you've got your company set up and you've got your company registration number, you will then need to open a corporate business bank account. So that's very important. It's not a personal account in the business name. It needs to specifically be a business bank account so that you can start your operations. Banks tend to take anything between a couple of hours. Some of the banks can open accounts that quickly. Some of them take a couple of weeks, depends who you bank with. We'll look at the filing requirements. So it gives you a feel for the amount of work involved with each option. So sole trader very much is, I guess, the easier option from an admin point of view. So you're only required to file one personal tax return, self-assessment a year. That runs in line with the tax year, and you have until the following January to file your tax return. And included on that, there will be sole trader pages, which you declare your income and costs. If you are VAT registered, you will then generally be required to file quarterly VAT returns with HMRC. Just so you're aware, the VAT registration threshold is £85,000. So if you receive income of 85,000 in a rolling 12-month period, then it is a requirement that you do register for VAT, or if at any point you will go over that 85,000. But if you don't sit in that, you don't need to be VAT registered. Limited company, again, bit more involved. Accountants will generally help do all or most of this with you, but a company will need to file annual accounts and an annual corporation tax return. They're done at the same time. They go hand in hand. One copy goes to Companies House, one copy goes to HMRC. There's a confirmation statement, which is a non-financial report that gets filed with Companies House each year. They charge a £13 annual filing fee for the privilege of filing that. And all it is it just confirms the basic company details, the director, shareholder, and the address, and just checks if anything's changed. Consequences of not filing that is Companies House will start proceedings to shut down your company. So although it's a very simple, straightforward filing, it's a very important one. Again, VAT, if turnover is over 85,000 in a 12-month period, then you're going to need to be VAT registered, and they're generally filed quarterly. If you've got any employees, or maybe as a director you are receiving a salary from your company will need to have what's called a PAYE scheme, and you're required to file monthly RTI submissions, that's real-time information submissions, to HMRC to tell them what your salary is, and the idea is you're supposed to report that before you take a salary. There's also a P11D report, which is filed annually, and that tells HMRC if any of your company's employees, even if it is just yourself, are in receipt of what is known as taxable benefits. A taxable benefit could be something like private medical insurance, private gym membership, or company cars, things like that. And generally, as a director and or shareholder, you as an individual, you will be required usually to file a personal tax return self-assessment with HMRC as well, and that is used to declare any income that you personally receive from your company, which could be salary and or dividends. The risks of both options. So as a sole trader, because there is no separate entity for your business, effectively it all sits under yourself. There is a bit more risk involved in that if there is a legal dispute for whatever reason, that's taken against you, and worst case scenario is your own assets are at risk. With a limited company, there is more of an arm's length there, because you and your company, even if it is just you as the only director and shareholder, are two separate tax entities. So any dispute potentially with your limited company generally will stay with the limited company and not you personally. So your own assets are generally wouldn't be at risk. With either option, we would recommend taking out company insurances or business insurances, such as public indemnity, public liability insurance, things like that. IPSE, I know, can help with that kind of thing, and it just helps cover you from any disputes that may arise. The responsibilities of both options, again, sole trader, it's a little bit more informal. With a limited company, being a director, you kind of have a legal obligation to ensure that what you do and your operations are in the best interest of the company and the shareholders. As a sole trader, it's only you, so you don't need to be as strict in that respect. Just a final point on that I guess we've observed, and it's not saying there is a right or wrong, but feedback we've had from some of our sole trader clients is that sometimes they felt that business opportunities may have been overlooked by them because they're not limited companies. So potentially some end clients prefer to work with limited companies rather than sole traders. Some of you may have experienced that. So what we'll go through the rest of the slides is looking at comparing sole trader and limited, and you can sort of make a decision or an assessment based on your operations to see if you're sitting into the right category of sole trader or limited. So now we'll look at some of the financial differences. So typical expenses, the tax rates that you're paying, and then probably the most important bit towards the end there is some tax planning scenarios, and then we'll look at ways to potentially reduce the tax that you are paying, because that's what it's all about, hopefully. So expenses, with either option, sole trader or limited, the HMRC guidance very much is any expense that's going through your business has to be wholly and exclusively necessary for the business. And what that basically means is they don't want you putting anything through your business that is a personal cost or that you generally personally benefit from, where the company or business is paying for it. If you're a sole trader, then simply you wouldn't be expected or allowed to allow any personal costs. For a limited company, same principles, but if there are any personal type costs going through your company, generally it would then be classed as a taxable benefit in kind, and you would need to declare it on a P11D report, which was one of the reports I mentioned a little bit earlier. So what we'll look at now is the typical type of expenses that can be claimed, but the main difference is, before we move on to that, is pensions. A limited company can make contributions into your pension on your behalf, and that is classed as a cost and attracts corporation tax relief. For a sole trader, it doesn't work like that. You can pay into a pension and make pension contributions, but you've already paid tax and national insurance to have them funds to be able to do that. So we'll look at that in a bit more detail in a little bit as well. Hopefully there's no great shocks or surprises, but I'll just whiz through the typical expenses that can be claimed. Sometimes you may not think you can claim anything, but very much you can. And just to give the context of why claiming expenses is a good thing, it will reduce your tax. As a sole trader, you very much are taxed on your income and your profit. So in one hand, you've got your income, your sales. In the other hand, you've got your expenses and your costs. And what's left is what's chargeable to tax. Same principles work in the company for the corporation tax. So ensuring that you are claiming all your expenses and costs, no matter how small they are, it ultimately means you are lowering the potential tax burden for you or your company. So computer costs, whether it's actual physical computers, laptops, tablets, phone handsets, if you need these things to effectively or efficiently run your business, it is absolutely fine to put these costs through your company or business. And on the other side of that could be software. Zoom licenses, Adobe 365 licenses, so any software that you might need also to run your computers and business is generally all allowable. Stationery, whether it's pens, pencils, paper, ink for your printer, things like that. Travel and accommodation, so you are able to claim travel to your client sites. So generally you are able to claim your commute depending on how long you've been working in a specific location and for a specific client, but generally you can claim your commute to your client site as well as business meetings, even if you need to go to meet prospective clients or suppliers. Travel is all allowable. Whether you're traveling in your own vehicle, you can claim business mileage, or you can also claim train tickets, parking, toll fees, bus, things like that. And again, any associated accommodation if you have to stay overnight somewhere, hotels, Airbnb, things like that. Something that's come up probably more since COVID times is commonly now known as working from home allowance, but HMRC call it use of home allowance, where if you are working from home or effectively running your business from your home, which would generally be the case, you can claim a unreceipted monthly an amount of 10, 18 or 26 pounds a month to claim as an expense to reduce the tax burden. There is a more in-depth calculation that can be carried out if you have a dedicated home office and do predominantly work on client work from home. Then there is a more in-depth calculation that looks at utility costs and the cost of running one room in your property. So you could claim potentially more than the £26 a month. Company insurances, I mentioned public liability, public indemnity, things like that. Generally, you will buy these insurances as a bundle that cover everything you need, and you'll probably find that if you are a contractor, for example, it states in your contract that you have to have certain insurances and a certain level of cover. So do check your contracts and make sure the insurance that you have got covers that. Most important one is accountancy. So they are all allowable costs for anything you do pay to your good accountants. Mobile phones, if you're using your mobile phone for business calls, you can claim for business calls. And again, generally, if you need a new phone handset, maybe you need a better one than the one you've got because you're using your phone for more than just calls. It is effectively a handheld computer. You can generally put through a new handset through the company. There's a couple of weird and wonderful allowances that I'm going to go through now. They are more directed to limited companies in that they are generally available to employees. You can technically have employees as a sole trader, but that's not so common. So first one is called an annual event allowance. It's or commonly sort of known as a Christmas party allowance. So HMRC allow an employer to, I guess, not pay its employees to cover an event on behalf of the employee, such as a Christmas party. And they will allow the employer to spend up to £150 per head on an event without it being classed as a taxable benefit in kind and therefore being taxable to the employee. If you're in a situation where it's just you're maybe you're running your own business, you're the only director, the only shareholder, it still applies to you. You can still use that £150, but the likelihood is you wouldn't just go out and do something on your own. So it is acceptable to maybe do an event, whether it's a meal, a cinema trip, a theatre, spa day, night away. It doesn't really matter what the event is, but potentially you can have or bring your partner with you, and that effectively does technically double the allowance, because it means you could potentially spend £300 because it's still £100 a head. Should make it clear that the annual event allowance is directed towards entertaining the company's staff. So it wouldn't be a case of, you know, you're the only director, but you invite all your friends and try and kind of exploit the allowance there. So there's a bit of a, I guess, common sense approach on that one. Next one is trivial benefits, and this was something that HMR introduced a few years ago to allow employers to reward its employees for like milestones. So that could be work anniversaries or personal anniversaries, birthdays, things like that. Importantly, it's not a way of compensating an employee for work or work well done. It's just as I guess a quick and easy thing that an employer can reward its staff with for smaller things, and typically what you can do is buy gifts or vouchers. So that looks at the trivial benefits. That is available to directors. Similar situation to before. If it is just you in your own company, technically, yes, you could claim that because it's not restricted to non-directors. But the point of trivial benefits is for an employer to reward its staff for certain things, and we don't quite believe that a director deciding to reward themselves for what they're doing kind of sits in the spirit of what it's intended for. So our own recommendation, we would always err on the side of caution. If it is you are operating on your own, we would suggest not to use the trivial benefits. But if you do have genuine employees, then certainly you can take advantage of that. So we'll have a quick look at the typical tax rates that a sole trader versus limited company might be paying. It is very sort of numbers orientated, these ones, so I'll probably whiz through these quite quickly. So for a sole trader, your profits that you earn for your business sits into what's known as the income tax bands. So these are the same rates and the same bandings that you would be paying if you was like a traditional employee, like myself and Grant, for example, where you receive a personal allowance. So first 12,570 of your income is tax-free, and then it goes up in bandings. So the higher your income, the higher the tax you pay. For a limited company, the only tax the company will pay is the corporation tax. So we mentioned that is 19 or 25%, depending on the level of turnover, or it could be somewhere in the middle. But as a director and shareholder, you pay tax on the money that you personally receive from your company. So you might receive a salary, and you might also receive dividends. So being a shareholder means that you can pay yourself and receive dividends from your company. And you can see the rates there. The basic tax band rate on dividends is 8.75%. So it is a very low level of tax that you are paying on dividends until you go into the higher tax banding. When your income goes just over 50,000, then the tax rates do jump up. National insurance. So as a sole trader, when we look at your overall profit, you pay tax on the profit per the previous slide. You also pay class 2 and class 4 national insurance. So these national insurance payments will contribute towards state pension and state benefits and things like that. But you'll typically pay class 2, which is £3.45 a week, and then class 4 national insurance is 9% until you go into the higher tax bracket, where it then drops to 2%, and that is paid through your personal tax return. So you pay your tax and the national insurance through your personal tax return in one lump payment to HMRC. For a limited company, the company itself doesn't pay national insurance, but it can pay employers national insurance on salaries. Generally, if it is maybe just yourself operating as a single director, a shareholder in your company, with careful tax planning, you potentially take a salary that is below the tax threshold and below the employee's national insurance threshold as well. So you're not actually physically paying national insurance, but in some cases, depending on the level of salary, the company may have to pay employers national insurance on the salary if it's over 9,100. So now we are going to look at a couple of scenarios where sort of take-home scenarios. So we've got 2 for sole trader, we've got 2 for limited based on the same income levels, and then I'll go through some tax planning sort of suggestions, and we'll see a revised scenario where your take home hopefully will be higher. So example 1, we're looking at self-employment profit as a sole trader of £70,000 as an example. We're assuming no expenses, or that's after expenses. So you can see that the take home is just over 50,000. That calculates to a take home of about 72%. Example 2, same principles, but a higher profit of 100,000. So it is all very much in the half that income sits in the higher tax brackets. So the take home percentage of example 2 is 68%. So 72 and 68. So the higher the turnover, the more tax and NI you're paying. So similar scenario for a limited company. So example 1, we've got profit of 70,000, and example 2, 100,000. But in this, we've got a salary. So any salary the company pays to its employees, or even yourself as a director, shareholder, is classed as an expense and as a cost. So what that means is your salary itself will reduce the profit and therefore reduce the corporation tax. That's why you can see a salary on there. So what we've assumed is that after the corporation tax is taken out, you receive everything, all the remaining funds, as dividends. And by doing so, we've calculated the tax and the take home. So example 1, the take home is about 75%, and example 2 is about 67%. So it's just under the efficiency of possibly what would be with the sole trader option. So now one of the most important things to start sort of thinking about is ways that you can reduce your taxes. So with a limited company, there is a lot more flexibility. So here we'll look at one of the, or a few of them. So pensions. I mentioned earlier, a pension is a cost to the company. So what that means is you can use your income in the company to contribute to a pension. From this year, a company or an individual can receive up to £60,000 into a pension. So potentially there's scope to pay quite large sums if you are fortunate enough to have the profits available into a pension. By doing so, you reduce your corporation tax. And it could be the difference between, not necessarily between paying 19 or 25%, but it potentially can close that gap. For a sole trader, you can pay into a pension, and there is potentially some tax relief that can be claimed on your personal tax return. But to pay into a pension, you're using funds that you've already paid tax and national insurance on. For a limited company, it's tax-free money that you're shifting into a pension. So the tax savings are much, much higher. Deferring your income. So this is a simple one, but may not realize. So sole traders, you very much declare your profit on your tax return, you pay your tax and NI, and that's it. There's no flexibility with deferring any of that income. It very much is what it is. With a company where you are a shareholder and you get to decide what you pay yourself, you can actually decide how much to pay yourself generally through dividends. So what that potentially means is, when we looked at them examples, all the profits were taken as dividends, and there would likely be higher rate tax to pay on them dividends. But you might think, well, actually, I don't need all that to live off of. What's the point in taking £70,000 of dividends when you only need 40,000 to cover your bills? So you can actually decide what to pay yourself and when to pay yourself as dividends, which gives flexibility on, I guess, controlling the tax that you might be paying. So there's a lot more flexibility there and autonomy for you to be in control. With that, you don't get that with being as a sole trader. Companies can use reserves in the company to to invest, whether it's shares, properties, cars, crypto. Accountants aren't a fan of that, but that is a thing now. Importantly, whatever the investment is, it has to be in the company name. Can't be in your own name, otherwise it's not classed as a business investment. But you're using reserves in the company, so there would already have been corporation tax paid on the reserve to get the reserves, but you're not having to take them funds and pay them to yourselves and then invest them personally. So there's again, like a sole trader, you can make your own investments with your own cash, but you've already paid tax and NI to get that. A company can make its own investments. Electric cars, very, very good way to, at the moment, to get a company car. Over the years, depending on how long you've all been doing this, you may remember many, many years ago, company cars, they've never been terribly tax efficient, but what has been happening is HMRC have been cracking down and raising the tax rates for anyone in receipt of a company car. And to give the context how it works, the HMRC tax an individual for receiving a company car. That tax is calculated by looking at the value of the car when it was brand new. So even if it's a second-hand car, you're paying tax on the original list price and the CO2 emissions. So the more expensive the car and the least economical it is, the higher the tax that's paid. There's a calculation that's carried out, and you are required to pay tax for having a company car. However, with electric, there is no CO2 emissions. So at the moment, to give you an example, with a £50,000 electric car, you could pay as little as £400 a year in tax, possibly even less than that. With a £50,000 petrol car, nothing too fancy, but it has CO2 emissions, you could potentially be paying £6,000 or £7,000. So there's a huge difference with fossil fuel cars versus electric. So that is something, is a consideration. And if the company leases or buys a car, there's corporation tax relief on new electric cars. And the last point to talk about is possibly bringing in your partner or spouse into your business as another director or specifically shareholder. The advantage of doing that is you get to share the dividends. So it means not everything's going to one person, which then potentially means that you may not be paying higher rate tax if your income doesn't go into the higher tax bracket. It all very much depends on your partner's financial situation and whether they're working somewhere else and what other income they may or may not be receiving. But it can potentially lower your overall taxes as a household. We would always say, if you are bringing your partner or spouse into your company as a shareholder, they should be doing some work for the company. They need to justify what they're doing as a shareholder to receive a share of the profits through dividends. Ideal scenario is that they may do some small amount of billable work, but it can be justified if they're helping, do the admin, booking meetings, scheduling your diary, and helping with the bookkeeping, all them good things. So they're helping to support you to be able to do the billable work. So now we've got another take-home scenario where we have added in a second shareholder, like a spouse or partner, who is receiving a salary and a share of the dividends. So we've got that set up in a 70-30 share split. So again, just to put context on that, because not everyone does realize, any dividends your company pays has to be in proportion to the share split. So if you own one share each, for example, that's 50-50. It means you both receive the same amount of dividends at the same time. If it's a 70-30 share split, it means for every £10,000 that's paid out as dividends, one would get 7,000 and the other would get 3,000. But importantly, dividends have to be paid to the shareholders at the same time in the share split. So you can't pick and choose what to pay each other based on your circumstances to lower your tax. That you can't do. So with this scenario, we've got second shareholder taking a salary, taking dividends as well. The take-home percentage has now raised to 77%. With the previous examples for limited company, it was 67, so it's gone up by 10%, and sole trader was 68%, so it's 9% increase in the take-home. This doesn't include pensions either, so potentially there's even more scope to reduce the corporation tax, and depending on whether you want to include pension as part of your take home in your calculations, that percentage could be higher. So that's enough of me talking now. I'm going to hand you back to Grant, who's got a couple of more things to go through, and then we'll be finishing up.
Thank you, Ryan. So sort of just to summarize what Ryan has been going through with you, there really is no sort of one size fits all model anymore. Maybe 15 years ago there would have been, but now with the changes we've seen to corporation tax and the dividends a few years ago, we're really starting to see that kind of tax benefit really shrink, when comparing kind of like for like. But as Ryan said, if we've got opportunities to add a spouse or a partner as a shareholder or as an employee, that really boosts that tax efficiency, allowing you to get more cash out at a lower tax rate. But there's also, like we've been through the kind of the day-to-day kind of stuff, and things, like exit strategy and future planning is really a big part of that now. We're seeing more clients building up cash to then invest, in property, which become a real viable option for those clients. And as you can see there at the bottom of the screen, we offer a one-to-one, free, no obligation one-to-one consultation. We'll go through your circumstances at the moment, what it is you're looking for, and the best way to set everything up for you. Like we say, whether that's a sole trader, if there's a couple of you, a partnership, or a limited company with a spouse or a partner, we'll make sure you get to where you need to be. I've been keeping an eye on the chat and the question box, and there's been quite a few questions coming through, which go through in a second. If you do want to get in touch with us, our details are there on the screen. You can ask for me or Ryan, and we're more than happy to go through any questions, have that one-to-one consultation if that's what you're looking to do and looking to make any moves. And as a thank you for sitting with us today, and listening to Ryan not waffle too much, we are extending our IPSE offer to IPSE members. So if you get in touch with us and you want to sign up to one of our fixed fee packages, just let us know that you were here today, and you'll receive your first 2 months for free. Like I say, just let us know that if you go through our website, on the forms there is a drop down as well, if you want to go through that way and go straight through the website. But otherwise, just let us know, and we'll take care of the rest. So for questions and answers, we've had some pre-submitted. So I'll go through a few of those, and there's one question that popped up I've not gone back to yet from Nigel, which I'll come back to in a second. So we have one of the questions was how can we get funding for a business setup, and how many months of business costs should we account for at the beginning? And that really, it depends on what your line of business is, and how you think the business is going to grow. There are brokers out there that will help you get finance. They're far more qualified in that side of things than we are. And they, you'll need, solid business plans and forecasting to see, what you're expecting to happen, and how, different levels of investment might change those models, for better or worse, so that when you do go to a lender, you've got that there, and they've got a good idea of what's going on and what they should expect as well from their investment in your business. We had a very common question, client hospitality and event expenses. It's very much looking at whether a cost is to maintain a current contract or relationship, or if you're looking to gain a new contract or business relationship. In those situations, and yes, we could, put the costs through as business entertaining, but they wouldn't be tax deductible. So unlike the staff kind of annual event allowance, when you're looking at the your client side of things, those wouldn't be tax deductible. But that's something obviously we could go through with you and make sure that you're making the most of those allowances. We covered a lot on obligations that popped up a few times. And again, if people are looking to get more information on that, then please do let us know, because it is, it's fairly straightforward in the limited liability or not, but then it's things like insurance, having that backing that, if anything does happen, does go wrong, making sure you've got insurance in place to cover you, and whether it's your liability or your company's liability, to make sure your assets are protected. And the one question that came up from Nigel, which I've not answered yet, which I'll answer now, was about subsistence when working remotely and on site. If you go, if you travel to a temporary site, the travel will be allowable. This comes back to the commuting that was mentioned earlier, travel to temporary sites, and this covers the same. If it's temporary site, then your subsistence is usually allowable. If you're staying overnight, then you're going to be able to claim that evening meal, and the breakfast, as well as obviously the hotel costs. And if it's in the UK, £5 overnight incidental, which is there, buy a newspaper, forgot your toothbrush sort of thing, or if it's outside the UK, it's £10 a night. I think that covers a lot of the questions. There are a few others. What we'll do is put some more detailed answers in a document. If we can get that in time, it will be on the correspondence from IPSE. If not, we'll make sure that's on our website, and all the questions will be there and available for everyone to see. Even if there's a question you've not thought of, you'll see it on there. And if that gives you anything to ponder on, then do let us know. And like I say, we'd be more than happy to have a conversation and take things from there. So other than that, really, like we said, it's very much, sole trader versus limited, or partnerships as well. It's very much tailored to you, your situation, your income, your expenses, and the partner and spouses, electric cars, things like that will make a big difference. And yeah, we are here. We do lots of tax planning all the time with our clients, so we're always keeping on top of which is best, which is for you, and also then obviously preparing for tax liabilities and when those might be due. So that's it from us today. We'll pass back to Sarah to close off, and hopefully speak to some of you soon. Thank you.
That's great. Thank you so much, Ryan and Grant, for that. A very, very informative webinar. And thank you to everyone for joining us today. On the slide that's on the screen now, there's a QR code on the bottom right-hand side, and we'd love to hear your feedback from today's webinar. It's a really short feedback survey, just takes a minute or two of your time. If you want to just hold your phone over it, it will take you straight to the feedback survey, and I will also just put a link into the webinar chat as well, so you can click on that. And then tomorrow, IPSE will send out an email to everyone. It will have a recording of today's webinar. It will also have the details about the Integro exclusive offer to IPSE members. It will have the feedback survey link on there as well. And then, like Grant mentioned at the end, if your questions haven't been answered or you have additional ones, feel free to get in touch with either Ryan or Grant, or you can email them over to IPSE at events@ipse.co.uk. and we'll forward them on to Ryan and Grant, and I'll add the links into that to the feedback email tomorrow that everyone will receive. But for now, yeah, thanks so much both for today, and thanks everyone for joining. And I think everyone gets a few extra minutes at their lunch break, so we'll leave it there for today. Thank you very much.